Yeah.
Yeah, let's
Uh,
start.
yeah, my name is Satyam Chauhan, and I am in Southwest Ontario, Canada. And I'm a long-term investor. I have not much knowledge about option, and that was the main reason to join and learn. Um, I started learning, and I just came to know about selling put options, cash covered put option. That's the safest one, as I heard. And basically, if you think like if you should, you have a faith in a company and you can afford to buy 100 shares, you should do the puts, sell puts, and if it strikes the price, you can get into the discounted price. You can get that sell, and
Mhm.
whenever it goes up, you can sell that and you can get the profit. And correct, you please correct if I'm wrong, but that's the safest and that's the best way to start trading in options.
Yeah, that's in fact that's the advanced option. What you said, the cash covered
Mhm,
selling put.
mhm,
We find it's advanced option. It's good you have the right knowledge.
mhm,
Uh, it's good. I think you'll learn in a better way. The
mhm,
best way to start learning is to start learning what is a call option, what is a put option, and then we move on to buy or sell, call and put.
mhm.
Let's see how this session goes. Let's wait for
Sure,
a few
sure.
more minutes for others to join. Yeah.
Yeah, and for platform, I have Robinhood and Webull. Um,
Okay.
I've started in 2018.
Mhm.
I had some saving and I started like for long terms. So
Okay.
initially, I didn't know about good companies, so I put like whatever I found, and I got news. And
Mhm.
I did a mistake of buying a lot of penny stocks, and I lost few
Mhm.
$100s in there. And I learned like not to go with all the herds and not to invest in like penny stocks without any knowledge. So I learned from my losses and my mistakes.
Mhm.
And then whenever I got like more money, I tend to put in a good company. And now I have a good 2000 plus profit in my long term shares on my Robinhood portfolio.
Mhm.
But now I joined Webull, and I can see like a lot of technical information and a lot of more advanced options in Webull.
Mhm.
And ready to do like I'm ready to start with options. So I applied and I was approved for long term puts and sell long term call. So
Mhm.
I'm trying to find out like what's long term options. And they don't have right now for cash covered puts options, but
Okay.
they told me like they will start soon, like they will get that feature soon.
Okay, that's good. We have Shifan and Harsh joined the call. Shifan and Harsh, do you like to introduce yourself and what is your experience or exposure to options and what you like to learn from today's session? Shifan, go ahead, please.
Yeah, hi, how are you?
Yeah, I'm good. How are you?
Okay, good. I'm still new, so what I do, I just listen because I have started with, few days only, just few days, and so far I have done about 7 stocks options,
Mhm.
and all of them are successful.
That's great.
So yeah, and I started with Intel. I just bought just one contract, and I made about $16 just to try. I don't know what is option as well.
Okay.
And the second one, I got alert from one of my friend in the group. So he
Mhm.
has given me Apple and Oracle.
Mhm.
So I made about 25 to 30%.
Mhm.
And Apple, unfortunately, you know what happened to the Thinkorswim, some issues. So that's really the alert works, and but platform problem. Then I lose a bit, not much, and About 20% I lost. Then I cover from Oracle and
Mhm.
Microsoft. So today I made some money from Walmart, also Oracle again, and work. So most of them are successful. There's really good alerts. So I like to learn more about the options and continue with you guys. Really.
That's good. Even though you don't have experience, you say you already. I mean, you just
Yeah,
tried, and most of
all
them
of
are
them
successful.
mostly is about 25 to 30%, 25 to 30%, and the last one is a 35% Walmart.
Okay,
Lucky I
great.
got. Yeah.
Okay, we have Aditya and Mayur joined. Let's hear from Harsh.
Hey guys, how are you?
Good.
Hope
How are you?
everybody's having a great weekend. Sorry, like Friday night. Um, yeah, I've been doing options and trading from a little bit like trading, basically stock trading. I've been doing it from very long time, and option just I was recently started. I'm not experienced, but I'm ready to learn a lot of things in the options. I've been doing it from this pandemic, I would say.
Mhm.
So far successful, uh, based on the like average. I would target to get at least 40 to 45%, and so far it
Mhm.
works out really well for me. But you never know. It's options, a big gamble. So that's all I know. But yeah,
Okay, that's good. We have
just a little
pretty
experience,
good
not
knowledge.
much.
Mhm. Okay, let's hear from Aditya.
Oh, hi everyone. Sorry, I was on mute. Hi guys, my name is Aditya. I am new into trading and new into options as well, to be honest. I've never done options.
Okay.
But in terms of trading, yeah, I've been in a couple of groups wherein I've started to do it in the past 2, 3 months to try and understand how it works.
Mhm.
To be honest, I didn't make much of profit though, but yeah, I'm still in a position wherein since it's a learner, I know that it's not every time that you make profits. So I want to understand it. And coming from an options perspective, yeah, I see people saying that, okay, they buy it at some strike price and sell it at something, and then they look at a future selling or buying. So I don't understand the terminologies, but I know that they're trying to make money out of the stock price rise and fall of it. So that's about me from trading and options perspective in terms of my knowledge. I don't have anything, to be honest, from an options perspective.
Okay, that's good. Let's hear from Mayur. Hey, Mayur. Yeah.
Hey guys, yeah, sorry I was on mute as well. Yeah, no, good to meet everyone. I'm Mayur. I'm probably very new to trading itself, and like one of the recent seminars I heard was on options, like probably 2 weeks ago from Siddiq. So I thought I should learn more, and so I was talking to Vijay about some beginner level seminars, and this one sounds perfect. So I look forward to hearing from you all.
Okay. We have Abhishek, Fatima, and Ambika. Anyone wants to introduce yourself? Please go ahead.
Hi, I'll just quickly introduce myself.
Sure.
Hi, I'm Abhishek, and I have recently immigrated to Canada on permanent residency, and I am a CA from back in India. So I am actually aware of how the FNO functions in back in India, but uh, Canadian markets and US markets I'm pretty naive. So I just wanted to get the basic understanding of how it works in, and then probably try and learn it in a deeper way. So thought this could be the right way to go ahead.
Okay, that's good, Abhishek. Anyone else want to introduce? Go ahead. If not, we'll start in a few minutes. Okay, let's start then. So few of you have some good knowledge about options already, and someone has already traded and they're successful even without knowing the basics. That's good. It's a good start. Let's start with some basic terminologies. So everyone understands call and put? Anyone doesn't understand what is call, what is put in options?
Aditya, I don't know anything about it, to be honest. I'm completely new.
Okay,
Me too.
then sure. Then we will start from the basics. So everyone knows what is a stock, and the stock price always goes up. That's expectation, right? The stock price keeps going up and down. We know that. And there is a day trading, there is a swing trading, and there is long-term trading. Long-term is investment, not trading. So the index, there is something called index. So I'm sharing my screen, hope everyone can see. And there is S&P 500 index, and we talk about it in the group. And there is a NASDAQ index. Let's take these two. And the S&P 500 corresponding index is SPY. Sorry, ETF is SPY. And the NASDAQ one is QQQ. I hope most of us are aware of this. Let's go to options from here. Let's take the SPY as an example. If you guys are familiar with SPY, or can I take on some other stock, Tesla or Apple, as an example?
Can we take Apple or Apple?
Apple, okay, good.
Yeah.
I think that sounds familiar. Even today, there is a lot of movement in Apple.
Yeah, that's right.
Okay, so first thing, let's be clear what is a call and what is a put. Okay, before we understand call and put, I would like to introduce a few more terminology. There is something called short selling. I believe everyone knows buy and sell. So other than the stock market as well, we know what is buy and sell. Any product we buy and sell, we know it. We have to pay a price for it. So usually we make profit by buy low and sell high, right? And before understanding the call and put difference, let's understand what is short selling. So first, normal transaction we make profit is first we do a buy and then we do a sell. Short is the reverse. First sell and then buy. So how can we make profit in this? Is this clear? Short selling, this concept. We are not going to do a short sell. I'm not explaining anything about day trading here. It's mostly a day trading terminology, short sell. But to understand what is a put, I'm introducing the short sell concept. So first we sell a stock and then later we buy the stock. So how does it work? How can we make profit in this transaction? Can anyone tell how to make this as a successful transaction? So let's say I sell. I sell a stock at 100. So I get 100 credited to my account. At what price should I buy it back to make a profit? Just give me one example, anyone?
Anything less than 100, you will make a profit.
That's good. Yeah. So I sold it for 100 and let's say I bought it back at 90. So I'm in profit of $10, right? This is short selling in simple. If this is the new terminology, just try to understand. If you're already familiar, let's move on. Now call option is, see, everything is buy and sell. If you simply, in simple terms, if you see, everything is a buy and sell, right? Every transaction we make is buy and sell. But there are different names we call. What is bull and bear? Can anyone explain? If you don't know, I can explain.
Bull is when the prices are going up, and
Okay.
when they're trying to put the prices down.
That's good, right? So how what are you betting on? Let's say Apple. What are you betting on? Are you bullish or bearish?
Bullish.
Bullish. Okay, so you want the price to go up.
That's right.
That's right. So again, if you see, everything is like dual, right? Buy and sell, bull and bear, but everything has a different meaning. So when we say bull, I'm bullish. I'm betting to go up. Let's say I want Tesla to go down because it's so high, whatever reason it is. I'm bearish on Tesla. So this is one understanding, right? And let's move to call and put. So what is call? Maybe I should explain with some picture. I didn't prepare any slide, but I try to open one. Just trying to. learn. There is some example on how to sell stock or short selling here.
Now, Vijay, one more. Sorry, this is
Yeah, go
Vijay,
ahead.
right?
Yes, Vijay. Who's this?
This is Moin, Vijay.
Hey, Moin. Yeah.
Hey, brother. I have a quick question. Now, short selling is like what? Like, how do you exactly do short selling? I heard a lot about it. I never did it. I only do option. Mostly, it's options, call put and stuff like that. But never did the covered calls, short selling, and stuff like that. So when you say short selling, first of all, how do you? Let's take an example of Apple. Okay.
Okay.
Do you have to own some shares, or does it work like options?
Okay. So it's more like day trading terminology. Okay. For the context of option, we don't need, but since the question is asked, I'll just try to explain. It's a day trader's terminology where you need a margin account basically to a short sell.
You cannot do it with a regular account.
No, we cannot do it with a regular account.
Okay.
Right. So you need a margin account for short selling.
Okay.
So that is where they have a margin power or a buying power or maintenance excess. They have, if you have a cash of $1,000 and they give you a margin power of 3,000, usually 3 times more. So for 3,000, you can play within the day. But end of day, you have to just make it back to its original position. Original cash.
I mean, the margin account only you can use the short sell, is it?
Yes, you need a margin account to short sell.
I mean, short sell means day trading, right?
Yes, short sell is mostly associated with day trading, but to understand the call and put terminology difference, because theoretically someone might already know a call and put. Sometime back we might have read what is a call and what is a put. But to understand it more clearly, I'm trying to explain what is call and put. Okay, in terms of understanding the short sell. Okay, let's move to call option. If you can open, just give me 1 second. I didn't prepare it. Where is that? I have shared it before, but we need time to recollect. I don't have it.
It's easy, Vijay. You don't need to read you're a champ. You can just say what the call is.
But someone, I got it. Yeah, I can explain it, but I should not be the one who's simply talking. I shared this screen already, so I'll try to explain the call and put with this one. Okay. So, okay, let's go ahead, start with this one. So the benefits of an option is a lower upfront cost. Yeah, I'm not going to read. Maybe you guys can just read. Let's move on to, you might have seen it already. Let's move on to the basics, call and put. This is what I was trying to explain. So to easily understand, they have a picture, call, pick up and call. You want the price to go up.
That's right.
Put down. So when you say put.
I'm not sure whether you're sharing anything. We are only able to see the investors business daily screen.
Oh, thank you. Thanks for reminding. Yeah. Great. That's great. I'll share the screen. Okay.
Oh, now we are able to see. Thank you.
Thank you for letting me know. Yeah, I fixed it. Yes. So when you say put, you want to put down the stock. You want to price to go down. So in other words, the bear and bullish terminology will help here. So call option, if you are bearish, buy a call option. If you are bullish, if you want the price to go up, buy a call option. If you are bearish, you want the price to go down, buy a put. Remember, both of them are buy, right?
Yeah, buy to open.
Yes, buy to open. That's right. That is one terminology. BTO, buy to open.
BTO, STC.
STC. That's right.
Sell to close.
Hi, Vijay. This is Aditya. Yes. Sorry, I just have another question. So when you select a stock, how are you going to determine that it is going to be in a bearish situation or a bullish situation, like when to buy a put or when to buy a call? How do you determine that?
That is technical analysis, fundamental analysis. That is a separate topic. It's like direction. Yeah, I got your question. So we need to be good. There are 3 different parameters we have to look while buying or selling a call option. one is the direction of the stock price. It is going up or down. So you're betting to go up or down. How you decide up or down, that's a different topic. Okay, it's a technical analysis involved if you're using a chart, and there's a fundamental analysis if you know how to read the balance sheet and income sheet, right? That's a different topic. Let's say you need to know one of the parameter is whether it should go up or down. That way you choose it's a call or put. So if you are up, if you're betting on up, price is going up, you buy a call option. If you know the price is going down, or if you speculate the price to go down. Yeah, I didn't answer your question directly, but that's a different topic. You can have a lot of analysis, right? That's a separate topic. We'll if you're interested, we can cover that in future.
Yeah, I think that will be better. We can cover that later. Thank you so much.
Yeah, maybe someone can note it down, or you can note it down. What are the topics? You can note it down, Aditya. That would be helpful.
Okay.
What are the topics we can cover in future? So, yeah, thanks. All right. So the call options are when you want the stock price to go up, fine. And the call is the right to buy a stock at a predetermined price that is called a strike price. So the second parameter is the strike price. So I want Apple to go to 550. That's the strike price. That's my strike price. Or I want Apple to go to 600. Then 600 is my strike price, right? On or before the expiration date. So which day I want to go to 500? Easily
before it expires.
Before it expires. So you had to decide a date, which week, by next week, next Friday, or after a month, or after a year. So you have to choose a expiry date. So we covered the 3 parameters, I believe. The direction, up or down. Based on that, you come to call or put. Within call or put, the strike price and the expiry date. Both you have to choose. Is that clear, everyone?
Yes.
Okay.
Vijay, sorry, one more question. Sorry about that. So when you when we say do a call or a put option, say for example, we determine that the stock is in a bullish scenario, and then as you mentioned, we put a call option and then say for a month, and wherein we wanted to go to say 500. Okay, from 450 wanted to go to 500. Suppose say what happens if it say goes less than 450, and say if it hits more than 500, do we get more, or does it just hit a take profit thing and we get a
more? Yes. So when you buy, when I buy for 550, yeah, I want the direction to go to 550. If it hits 550, I'll be in maximum profit. But even the price moves in the same direction. Let's say even if it goes to 520 or 530, let's say today the price is 500. And I want the price to go away 550 the next week. Even if it goes to 520 or 530, I'll be still making some profit. And does that answer your question?
Oh, yes, it does. So which means that we can exit at any time, right? It's not like
Yes.
it needs to hit that money at that amount.
Yes, you can exit at any time. So
okay.
Yeah.
And what happens if it goes beyond 550, say it goes 560, so our take profit gets cut at 550, or do we still have a chance to take higher profit?
Once it crosses 550, it's unlimited. The profit is unlimited.
Okay.
The risk
I think there is a website called Option Trading Calculator or Option Profit Calculator. You can basically go to that website, and then it will tell you exactly what's gonna happen if your option price is, you set it, let's say you set the option price for the Apple to go at 495, right? And it's went for the next week, and the 495 already passed, and then next week if the price goes from Apple to 495 to 500 or 550, right, the profit goes beyond the limit. Like there is no limit on it. Like, yes, this is the site, Vijay.
Okay.
So if you go just select Apple get price, you get it. Now if you go to the option, there is a select option.
Buy
yeah,
option,
select option.
Okay.
And just go and select the date of any of this. Is again, like, this is one of the best way I learned myself how to calculate the profit perspective. Okay,
that's good. We can take this one. Let's say now now what's happening here is, so now the price is at 495. And this is where
So-
the cutoff line is. You guys see,
Yes.
on the left it is call option, on the right it is put option. Most websites or the brokerages will have the similar one. So on the left it's call, on the right it's put. So 500 is the current price. Let's say 450 to 500 is the current price. And
So select
say
that
5
1110, that 1110 price, the middle one.
Yeah.
Yeah.
I click
So if you
that.
select that, and what's going to happen now? So basically this is calculated by the one contract. So each contract you are paying $1,100, and now in the graph range, it's right there. It says graph range.
Okay. Can I press that? Should I
Yes, you
select
can
something? Auto. Both are auto. Okay.
For the graph range for the 5, so like here's the thing, right? Like if the option price goes beyond 530, what's going to happen? You won't see. So if you change that 530 to $600, if you scroll up,
Yeah, 600.
yes, 600, and now do a calculation. So this is exactly what's going to happen. So let's say you targeted the price for $500 or $495. Okay, so sorry, $500. The average call average price will be like 520, 530 somewhere. So to make the profit over 520, the profit will be this. So now if you go and look at the 21st August, so let's say on 21st August, or sorry, 24th August, that's a Monday, right? So if you go to the 24th August, you will see it says 800% profit. But if you look at that, it says $8,892. So basically that $1,100 which you invested, you are getting $8,000. If the price goes to 600 on 24th, that's the future price for your option. The near the expiration date comes, your option, you will see the price will go down. It will decrease. So if you go back to 26, 27, it will gonna go down. The closer the date of the expiration of the option, the price, the delta will change, and the option price will go down, or basically your profit margin will go down drastically. This is one of the way, like I learned from the option perspective. This is very good site for for the beginners to understand, for the freshers like me, the way I learned it. So you guys can also keep it for yourself and track it, how things gonna be.
Thank you, Harsh. That really explains. Yeah, we can use this calculator, guys. So
Absolutely.
Let's go back to where we
Can I ask you something?
Sure.
Yeah, okay. As you said, Harish, before the expiry date, close to the expiry date, the price will be, lower, right? So it means if the price reach like 495, so again, okay, today 21st of August, so the price reached 495, or still the price will be cheaper, the premium?
Sorry, Shifan, I didn't get your question. Please.
Okay. He said close to the date, expiry date, the premium price will be cheaper, right?
Okay, I will cover it. There is something called intrinsic value and extrinsic value.
All right. Okay.
In the option price. We will go step by step. Yeah.
Okay.
Exactly.
Do you understand intrinsic value and extrinsic value?
Okay.
Yeah. We will talk about it. Yeah, sure. So let's go back a little bit. Okay. So if there is no other question, I'll move to the next basic learning. And a call option when you buy, or a put option when you buy, you have the right to buy. It's not obligation. It's optional for you. You can just buy and wait. You don't have to buy the 100 shares. Okay, what's the 100 here? By default, all the options transaction, whenever you make a transaction, it is a contract. So, and each contract is 100 shares, 100 stocks. So that's the multiplier. 100 is default multiplier. It can be seen in this here as well. The multiplier is always 100. So one contract multiplied by 100. So for example, here it is 11 0.1. The single contract you have to buy it for 1110 or 1110. So that's the 100 shares right to buy. Okay. So I think we discussed it already. The profit from a stock's gain without paying full price for the stock. So you don't have to really pay for 100 stocks when you buy an option. And at the same time, the downside is you might lose the entire premium, whatever you're paying. You might pay $100 in one transaction or $1,000 in one transaction. And the downside is you lose the entire money. That is, if the direction goes against you, you can lose the entire premium. The upside is the profit is unlimited.
I think the best way, the best way to describe that is you basically buying that 100 stock of Apple on the premium price for like $100 in the option, basically, right? Isn't that the right way to approach it?
Right. It's like you are leveraging. You are not buying 100 stocks, but you are playing as if you have 100
Future.
stocks. Yeah.
It is called future, right? So basically, you are saying that future, the price for the Apple will go in future 500, 550. That's a call. And in
Yes.
future, if you drop it, then you buy a put, saying like, I know in this next week the Apple will go down to 450. That means you are basically buying a put, saying like, hey, I know Apple will go down, so I'm buying a put for 450. I think that was the terminology you were using it. You want to use, right?
Right. That's right. Yeah.
Yeah.
And the expiry date is always in future, right? There is
Exactly.
Yeah, it's always future. Usually it is weekly options. There are every week Friday, there is a weekly options. And third Friday in a month is a monthly expiry. And there is a daily options as well, Monday, Wednesday, and Friday as well for the most popular traded ones. And this is the calculation. So maximum risk is the premium we are paying. Yeah, upside is unlimited profit. And there is a break-even calculation because we are paying a premium. And there is a calculation for how it break evens. Let's say I put $100. After how much price movement I'll get my $100 back. There is a calculation. So once we start looking into the numbers, these things will be obvious. Okay, this is an example. So let's assume this is an Apple, and the price is a 50 call option, and the premium paid is 4.50. Even in the calculator which we are seeing, you can see there is when we see a similar one. Is there a question? How can we get the video of this and get more calls about this? Okay, I will answer this later.
Vijay, I have one question.
Yes.
Okay, so for example, today with Apple, you must got an alert too. Apple expiry 28th August 5:50 when it was trading at 494. So I know that the more it goes higher, that's how your, for example, $1.70 call went up to $3.40 or $3.30.
Right.
When it was trading at 499.47.
Yes.
Then the price. So do you, okay, if I would have said that, let's say that 600, right? It would be more cheaper.
Right.
But how do you determine that? That's the problem. Like I could get 520, the premium would be higher for that. My question is this, is it the more risk or the more bullish you are? That's how you determine that 550 call? Even though if it doesn't touch to 550, it touched to only 499.45, but you got it for $1.70 and went up to 340.
Okay, there is something called in the money and out the money.
Okay.
For call options, everything above the 495 is in the money, because if you can see all the premiums are so high. So that means you are buying the option or buying the call, let's say 470 at 30. What is the difference? How does this 30 comes? 30 plus 470 is 500. Right? If you
500.
see the premium, it's always the difference. The current price and the strike price. Let's say I choose 450 as the strike price, and the current price is 495, and the difference is 45. So it's somewhere close to 45. Right?
Gotcha.
So anything in the money is always higher, because it is definitely going to make you profit. It's not going to, even if it's not going to make profit, you're not going to lose your premium. Right? When there is a guarantee that you're not going to lose the premium, then it's called in the money and the premium is higher. For example, if it is 400, why I'm paying $96 for the contract? Because Apple is already trading at 495, and I'm buying the right to buy one Apple stock at 400. So that is already in the money. That means in the money. So anything above 500 is called out the money. So that means we expect the price to go up.
So, for example, I could put it in this way that Apple is trading at 495, and I pick up the strike price of 450. Okay. Now my difference is that $45 which I'm paying. So anytime when it is going above 495, I'm making more, and if it's coming down like 495, that's where I'm losing, right?
Yes, that's right. Yes.
I am in call, but the more it's going up above 495, I'm making. But the more it's coming down, I'm losing.
Okay. If the call drops, I would request everyone to join back. I think there is a limitation. Please join back, everyone. It's going to end soon.
Okay.
Okay, I will continue this once we join back.
Vijay.
Yes.
You can use Teams. I think Teams is also free. They don't have any limitation as a Zoom, because I use Teams for certain calls like this. So